It's John Observation here. What we just witnessed in the silver market is not speculation, it's not rumor, and it's not internet noise. It's now officially confirmed by a major global exchange. The Shanghai Futures Exchange has released an official notice, document number 37, dated February 5th, 2026, confirming what many suspected but few could prove. A coordinated short attack took place in silver. 6 groups of linked accounts were caught exceeding intraday position, opening limits on silver contracts, and the exchange imposed immediate restricted position opening measures on all of them. This wasn't random volatility. This wasn't retail panic. This was a deliberate, coordinated paper operation, and for once, the regulator put it in writing. In a single morning session, 674 million ounces of paper silver were dumped, nearly double annual global mine production, and the exchange cracked down because the scale was impossible to ignore. As I'm recording this, prices tell a story most people aren't connecting correctly. Western spot silver trades around $74. Shanghai spot sits near 82. Shanghai futures are trading close to 99 with an $8 premium. That gap alone should stop people in their tracks because it reflects stress, not stability. And before we go deeper, a quick note for anyone new here. This channel will never ask for your money, never sell paid signals, never run funds, and never promise overnight riches. Anyone doing that using my name is running a scam. What you get here is verified data, context, and analysis, not repackaged hype. If you want moonshot fantasies or apocalypse clickbait, there are plenty of copycats who spin every data point into whatever narrative performs best that day. Markets don't move in straight lines, and reality doesn't either. I cover both sides with numbers because understanding matters more than excitement. Now let's lay out what actually happened. A massive short position was built, centered around a billionaire trader who accumulated the largest net short exposure in silver. When that position moved, it moved violently. The 674 million ounce paper dump on the Shanghai Futures Exchange triggered immediate regulatory action. 6 linked account groups were banned from opening new positions for abnormal trading behavior. At the same time, on COMEX, 3 million ounces of physical silver were pulled from vaults in a single day. Futures contracts were settling physically at a rate approaching 100%, compared to a normal range of 1 to 3%. Total COMEX inventory dropped to roughly 400 million ounces. These are not disconnected events. They are different symptoms of the same underlying stress. Then came the margin hikes. CME raised margins again, the third increase in just 10 days. Maintenance margins jumped 11% for gold futures and 20% for silver futures, effective after the close on Friday, February 6, 2026. This was the second margin increase in the same week, and importantly, it came despite falling prices. Silver margins surged from 15% to 18%. Many people misunderstand margin hikes. Exchanges do not raise margins because they feel comfortable. They raise margins because they are worried. If gold were the problem, gold would be hit harder. It isn't. Silver is. High margins signal stress. Stress signals positioning risk. And positioning risk means too many traders are on the wrong side at the same time. These hikes are not about protecting investors. They are about protecting the system itself. You can margin paper. You cannot margin call physical scarcity. That's why silver gets hit first and hit harder. The market tells you what it fears if you listen carefully, and what it fears is not gold. Yesterday's forced crash reduced COMEX total futures open interest by roughly 6,000 contracts, largely linked to tokenized silver products. Total open interest still sits around 137.7 thousand contracts, which remains dangerously high relative to the amount of registered silver left to settle those contracts. Open interest represents roughly 688.5 million ounces, while registered silver stands near 103.3 million ounces. We are approaching a point where either COMEX breaks or the banks do. With the March futures contract first delivery notice just weeks away, the exchange has only a few options: find a massive amount of metal, remove short pressure, and allow price to rise to where supply meets demand, or declare force majeure. Those are not opinions. Those are the mechanical constraints of the system. At the same time, Shanghai vaults saw a massive drain, dropping to around 350 tons of silver, roughly 11.2 million ounces. 15% of inventory left in a single day. Artificially suppressed prices accelerate physical outflows during shortages, and that's exactly what we're seeing. Physical silver is vanishing at an unprecedented pace. This isn't bearish, this is structural stress. Price is being forced down financially, while inventory is being pulled out physically. That divergence matters more than any candlestick. The math for March is brutal. COMEX deliveries in 2025 totaled over 474 million ounces, more than double 2024. Every month saw higher year-over-year deliveries. Participants are no longer rolling contracts. They're demanding metal. January 2026, usually quiet, exploded with nearly 50 million ounces delivered. February followed with almost 19 million ounces in just the first few days, nearly matching all of last February. Nearly 100% of open interest stood for delivery. This is no longer a traditional futures market. It's turning into a physical grab. March looms larger. Open interest stands near 429 million ounces. If even a quarter demands delivery, over 100 million ounces are required. At 50%, over 200 million. At 70%, close to 300 million. Registered silver continues to drain, falling from 167 million ounces in October 2025 to near 103 million now, with daily outflows accelerating. Eligible silver exists, but owners are not converting it at these prices. They are holding. They understand leverage. If this drain continues, later months face the same squeeze. Cash settlements, force majeure, or shattered confidence in paper pricing become real possibilities. The paper-silver empire is not collapsing from lack of belief, it's collapsing from arithmetic. Zooming out, yesterday's sell-off in crypto triggered broader deleveraging across markets. Tokenized silver products fed selling pressure into COMEX futures, ETFs, and swaps. Hundreds of billions evaporated from crypto market capitalization. At the lows, crypto, gold, and silver combined lost trillions in market value. Amazon fell sharply after earnings. Hedge funds dumped equities at the fastest pace since October. Geopolitical tensions escalated as warnings emerged around Iran. Everything sold at once. That does not happen in a free, healthy market. It happens under systemic stress. And here's the critical insight most miss. Price is down, inventory is down. That is not bearish. That is physical, leaving the system while paper dictates price. Stackers watch metal, not charts. Physical demand is accelerating into weakness. Singapore saw cues for gold despite falling prices. Australia, Thailand, China showed similar behavior. SLV trading volume hit record levels, higher than any stock globally, a sign of forced repositioning and capitulation. Technically, silver sits near levels seen months ago, but sentiment is the opposite. Same price, completely different psychology. This does not guarantee the bottom is in. Timing reversals requires confirmation. Risks remain real. Margin hikes, Bitcoin-led risk-off, geopolitical stress, forced liquidation. But fundamentals have not deteriorated. They've tightened. Shanghai officially confirmed manipulation. COMEX registered inventory is thin. Physical settlement is unprecedented. Vaults are draining while prices fall. Paper and physical are at war. So the question becomes simple but profound. Does March delivery break the paper system under the weight of its own leverage, or does forced deleveraging push prices lower before physical reality asserts itself? Shanghai has already shown its hand. Physical buyers are not backing off. The system is cracking in real time, both regulatorily and structurally. Know your time frame, understand the risks, use logic, not hype, and never follow anyone blindly.